Hey traders, Stephen Kowitzel here with thetradersplan.com. It is Thursday, about a little bit more than less than an hour before the close. We got a lot to cover today. The market is really in a flag type formation. I'm really hoping support holds. So we're going to talk about that and get a game plan in place. There's a lot of things moving. There are a specific niche of growth stocks moving really fast, so we're going to look at that. But I also want to talk today about a game plan. You know, the market has made a major move really since 2012, 2013, or even since the correction of 2015. So it's very possible that we just have a more challenging year or a sideways environment. And if that's the case, I want to put some tools in your pocket today in your trading plan to make sure that you have tools to trade stocks and commodities that are moving up. So we're going to talk about a little strategy today if the market does go sideways for a little bit and just continues to challenge us. I've been doing really well this year, though I hope you've been doing really well. Before I get into that, I want to bring up a disclosure real quick so you can read it. Let me just make this full screen for you. Let you read that. Excellent. Okay, so I want to start with the S&P 500, then we're going to move to an hourly chart in the Nasdaq and the small caps and get into breadth and some commodities and growth stocks. So, you know, there's this descending triangle. It broke out clear as day, right? And it's really interesting, and I know this is always hindsight. It's hard to buy. It's hard to step up to the plate and swing the bat sometimes when the market is so choppy. But you have to do that sometimes, even if it's a test position, let's say 25% of your account, something that wouldn't rattle you if you got stopped out. And then if that starts working immediately, then you can go to 50, 75, and eventually fully invested, which I am fully invested right now. And been doing pretty well. If what I'm looking for right now, and just looking at past corrections, and I don't mean to continue to beat you over the head with it, but rallies coming out of corrections, a lot of times they'll ride the 20-day moving average just like this. You know, now this isn't a correction, this is a pullback, but they'll come out, they'll test the 20-day a couple times, and then they'll make a nice little trend. Right now, we're still trying to find our way, but I like the fact that yesterday on Wednesday, the market reversed higher, and today, headed into the close, it looks like it gave the 20-day moving average a kiss. If this 20-day moving average doesn't hold, to me, that just means more slop. Doesn't mean that we're just going to roll over and sell off. I'm seeing some pockets of positive signs, but I think right now the market is just really hesitant, or at least the institutions are. They're taking their sweet time as far as trying to get out of this, which rightfully so. I mean, look at this monster move. The biggest moves, and I know people get frustrated that the market doesn't go straight up, I get that, but the biggest moves, you just have to be patient and understand that they have to digest their gains, and that is healthy. Typically, see what happens when you go straight up, you go straight down. So, you know, you want some sideways digestion, you know, just as long as it just isn't, you know, chop you up and spit you out kind of thing. But right now, as far as, you know, it broke out of the downtrend, clear as day, cleared the 50-day right here, cleared the downtrend, and is testing the 20-day. If this rolls back over, it's, in my opinion, not good. I want this 2,700 on the S&P 500 to close. Doesn't mean we're going to crack wide open and head lower, but it just means that you and I probably need to consider lightening up some of your positions. You know, cash is a position, so don't ever let anybody tell you otherwise. Something I learned from IBD, cash is a position. So, you know, if this breaks, I'm probably going, you know, from 100% invested to something more like 75 to 50% invested, depending on raising my stop. So right now I'm looking at all the positions in my portfolio. I'm setting a place that I do not want them going under. Just like I am the market, I really don't want the S&P 500 to break this 27. If it does, then I start to lighten up because I've made some good money on this trend right here, even though it doesn't look like much of a trend. It's treated me very well, and I don't want to just roll back over and give that back. So I'll give some of it back because I believe you have to be willing to risk some pullbacks for greater gains, but I'm going to take some proactive steps. So right now, it's just kind of in a wait and see. let's go to this 60-minute chart. So you can see how important, and I don't make trading decisions off 60-day charts. It's not something I even look on a daily basis, but sometimes when I'm in a trading range, I do, which we still technically are, at least with the S&P 500, we're in the middle of this zone between, 2550 and 2800. But I like to see where I think the short-term potential support and resistance could be. And right now, it's clear to me that it's at 2700. So we want, this flag, we want it to break higher. Could chop around for a little bit, but if it cracks this again, I'm going to lighten up some of my positions. It's something that I'm looking at very, very closely, but I'm trying to give my positions room to breathe. Let me change this. So this is the Nasdaq, and it looks prettier, in my opinion. But if you look at the Nasdaq, it's closer to the 52-week high, I think, than the S&P 500 is. You have a nice little flag right here, surge above, sideways action. I'm sure most of you have read Nicholas Darvish, how I made $2 million in the stock market, and he talks about how stocks, stair-step their way higher. And unfortunately, that stair-step, and it trades in boxes. And unfortunately, that stair-step and those boxes aren't necessarily always neat. Sometimes you have to take a step back and look at the bigger picture. But right now, that's what I see. I see a surge, a breakout. You got a little mini double bottom right here. Broke out right here. You should have been getting in right here if you were fully in cash. There's no reason to, always have a bearish mindset. And one thing I was noticing when the market was down here, that growth stocks were still acting fine. They were not rolling over. And typically the high powerful growth stocks that I trade, they're the first to go. So when I see that we're at a potential long-term support and growth stocks most of them are still hanging in there, that gave me a little bit more confidence to be a little bit more overweight stocks even before it broke out, because I would have expected the growth stocks to crack first before the market. And it didn't happen. So you have your rules to get you back in. You're trading it. Now we've been going sideways for a couple weeks. We've had a reversal yesterday, have a reversal today. That's great. Let's look at the volume. Yesterday was a tick up in volume compared to the previous days, but not necessarily above average. Today looks like we're trading 1.5. So Nasdaq typically trades 2 billion shares a day. It's billion with a B. So it's not really a lot of volume, but again, if it's reversing, it's hanging in there. I'm cool with that. One thing I've noticed, a lot of people always are like, stocks to me are a little bit different than the overall market. I put a lot more attention on accumulation with individual stocks than I do the market. But it's not like I don't pay attention to it, because I do, but I put a lot of emphasis on distribution with both. But I've looked at trends in the market, NASDAQ, and I've looked at really, really nice trends that didn't have a ton of accumulation days in them. So as long as the price is riding above that 20-day EMA, I'm in a good spot mentally, and think the market is in a good spot. I don't typically focus on oscillators or MACDs and all that stuff, I look at secondary indicators, but there's secondary prices first. So if secondary indicators are starting to show flashing signs, I'm not making a move until I see the price break. And with me, the price continues to right now just be that 20-day EMA. That is what I'm focused on. Until that breaks, I will be fully invested, unless I get stopped out of some of my positions, which happens. So you have the small caps right here, the Russell 2000. It's incredibly hard to be bearish when the small caps are so bullish, right? But keep in mind, they've had a nice 4-week rally versus the market's kind of been going sideways. So it's reasonable to expect a breather, but this surge right here, and this is a weekly chart. Look, 40-week moving average, 40-week moving average came all the way down, came back up, 40-week moving average test, and then a breakout. I don't know what you're waiting on. If you're still waiting, you don't want to wait until markets break to an all-time high. That's not where your opportunity exists. Opportunities exist out of, taking small pilot positions or 25, 33% of your portfolio at long-term support. As it's clearing little pivots right here, slowly sucks you back in. By this time, the market could be ready to pull back. So you want to have your rules to get you in. But right now, small caps are bullish because the dollar continues to strengthen. So small caps are going to lead typically the S&P 500 when the dollar is strong. Let's look at some market breadth, excuse me. So you have the S&P 500. We're not really going to look at the price chart because we just did, but this is the percentage of stocks above the 200-day moving average. And you can see there's nothing pretty about this breadth indicator, but I like to pay attention to the percentage of stocks above the 200-day moving average. That at least means that a majority of the stocks are in a long-term uptrend. I don't make trading decisions off it, but I like to, it's something I learned from Arthur Hill, pay attention to is 60% of stocks above the 200-day moving average in the S&P 500. If it is, that's a positive. It's not the only thing you need to pay attention to, but that's just one green check mark that you need to pay attention to. So there's broad participation, but look, it is not even close to the 83 or 4% it was way back here. Now, rightfully so, we're still down quite a bit, but we need to start, in my opinion, the market can head higher on fewer stocks, but if the market heads higher and this isn't curling up with it, it's telling me fewer stocks are pushing up the market, and that would be a yellow flag to me. And then I'll start to raise my stops. And when I see price breaks, price trumps everything. So when I see price breaks, that's when I'll start to unload and protect my capital. I don't really even look at this down here. I might glance at it, but I'm looking for less signals, not more, because the more signals you have, the more whipsaws you're going to have. So the less signals you have, the longer term signals, the less whipsaws. Now, you're still going to have whipsaws, but again, because you can see it's choppy around here, I think we need to get out of this. But right now, I'm okay with where it's at. But it's also telling me that, institutions, pensions, mutual funds, they're kind of taking their sweet time piling back in. So you have the dollar right here, and commodities have an inverse relationship. You don't even have to be a technician to see that they move in opposite from each other, right? But now it's kind of interesting because the dollar is screaming, like it bounced off this 8-year trend line, okay, headed higher. Is this a counter trend rally, or is it a new trend? We don't know yet because I think it'll have to create a new high and break above that pivot. But it's kind of looking like it's a new trend, but we'll see. But this is straight up. So the dollar's coming back strong, but the interesting thing is the CRB, the commodities, they're riding along with it. And it doesn't, this is why I don't trade relationships as far. So if the dollar is, strong, it means you have to short gold because gold will be weak. But a lot of times these relationships can decouple from each other for long periods of time. But right now they're both moving in tandem, which is kind of odd, but it can happen for a couple months or a couple years. But I'm really interested to see what happens with commodities because in the next couple years, I tend to lean that commodities are headed higher. I'm going to make a case for that here in a second. So maybe the dollar just comes back in here and then gets in a trading range. I don't know. But right here, this looks clear as day to me. An inverse head and shoulder neckline break, broke out, came back, shake out, and then just is headed back higher. Now in the CRB, you have oil that is a big percent. So that has been on a tear for the last, several months, which is helping the CRB. So it looks to me like a lot of the agriculture and other commodities are trying to turn a long-term downtrend as well. But you want to pay attention to when commodities perk up, and I mean when they perk up, they take leadership versus stocks. So today I'm going to make the case for if the overall stock market just gets into a challenging environment, and it could be challenging for a couple of years, like you don't know, but typically we're in the latter end of the business cycle where there's rising interest rates and rising inflation, which is, commodities push up inflation. So I think that it's just going to be interesting to see, and it's looking like the CRB is starting to take leadership over stocks. So most of us trade stocks, options, stuff like that, but I would definitely open your sphere, even your circle of competence, to try to understand some of these commodities, because we could go on a multi-year bull run in commodities and you could be stuck sitting in stocks that are going nowhere. So I'm going to talk about that and what to do and how to play it here in a second, but just something to be aware of, and let's dive deep into that. Now, speaking of commodities, this is a 3-year CRB, or relative ratio to the S&P 500. And what doesn't mean the CRB is going down. It just means that when the CRB when this line is going down, it means it's underperforming the S&P 500. And when it's going up, it means it's outperforming the S&P 500. So it's a relative chart. So if you look at the CRB the last 3 years, we've been in a pretty good downtrend. Well, now all of a sudden you have a couple things happening down here. You have a breakout of a 3-year downtrend, and I understand this isn't a perfect trend line. I could have drawn it up here and, but I think that no matter where you draw this down trend line, you can see that now commodities have broke out the CRB, at least relative to the S&P 500. Oil is strong, and that's mostly pushing it higher, but you don't know how high this could go. So you have a breakout of a downtrend of commodities relative to the S&P 500. You have a breakout of this, you could call it a first stage base. Now, this isn't a stock or an ETF. This is just a relative chart. But the point is, I was trying to make several points that it's looking like the trend has changed on multiple aspects on the first stage base and the downtrend breakout. So now commodities are going higher. I'm reading this book right now. It's a commodity book with Jim Rogers, who was a co-manager of the Quantum Fund with George Soros back in the 70s. Brilliant guy. He's a commodities guy. Now, he makes the case, and it makes a lot of sense, like why you want to try to own the futures contracts, because let's say if the S&P 500 is under pressure for a couple of years, and that's probably going to and the commodities are doing well. Well, it's possible that because all stocks are under pressure, that the commodity stocks aren't going to move because the market is under pressure. Whereas if you're on the futures, ETFs, I'm not telling you to go out and day trade futures, but if you own the futures, they can move and they're not being held down by the weight of the market. So we're going to look at some futures ETFs here in a second, but I don't know about you, but this is clear as day to me that my eyes are going to have to start being open to commodities futures, or just other commodities that have been out of favorable for a very, very long time. There was a huge commodities back in the 70s. A lot of these traders, back from the Wizards book, with all the interviews with all those traders, they made a lot of money in the commodities bull run in the 70s. Well, in the 70s, from 1968 to 1981, S&P 500 didn't do anything. I mean, it was a flat 13, 14 years, and commodities just took off. So expand your horizon a little bit just in case that happens. But right now, it's looking like it's perking up, and it has been perking up in 2018. So is this going to be a false rally and stocks take over? I don't know. We are in the midst of a secular bull market in stocks, but even in secular bull markets, you have bear markets, you have pauses, long trading ranges and things like that. So let's continue to look at commodities for a minute. Is this the one I want to see? Okay, so I updated this. So you have, and I love this chart because it just goes to show you how simple relative ratio charts, if you follow them, you can be in the right asset class for a decade or more. This is the S&P relative to commodities. So when this is going up, S&P is outperforming. When this is going down, commodities are outperforming. So it's from 1990 to 1999, S&P returned 266%. The CRB, negative 19%. That is a negative 285%, if I did that math right, differential. So I'm never a fan of holding commodities forever just because, 10 years is a long time for a negative 19% return. Just pay attention to the relative ratios. And from this time period, CRB returned 69%. So that looks like an average of about 6% a year over the time period versus a negative 8% for the S&P 500. an average of 6% return per year is for 11 years is a lot better than an average of negative 1% per year or more. The difference is night and day. So now you have from 2011 to present, S&P 500 has returned 125%, and this is to date. And the CRB is negative 35. But now look at the top. This relative ratio, the CRB is starting to, this relative ratio is starting to decline, meaning the CRB is starting to outperform. Is this a top? I don't know. Sometimes the tops, I mean, they can take a year to form before it just absolutely rolled over. Look at this top right here. In 99, you had a top, and it took a year, the whole year of 1999, for the CRB to take leadership and then make a 10, 11 year run. So it doesn't happen in a week or a month. These are very long-term charts, but these are very, if you appreciate the long-term picture, and you want your money to grow long-term, then, you know, this is stuff you need to pay attention to. So this is an interesting chart. This is RJI. It's a commodity ETF, the Rogers International Commodity Index Fund. Just a balance of commodities, futures contracts versus, you know, the S&P 500. So we're looking at the last 12 months, 252 trading days. So a lot of times it's especially good for a momentum strategy. It's good to look at if you have long-term ETFs. You know, look at the look-back period of 6 or 12 months just to see what's doing better, because a lot of times when that leadership takes over, it can take over for the next several years. Well, as far as this ETF goes, it is now taking leadership over the S&P 500. And you got this move, a lot of it, I get it, is oil, and that's the argument you can make, but it's happening. You know, it is happening. I'll never forget when I was a financial advisor, and this mutual fund salesman was trying to talk about the long-term average of this growth stock fund. And I was like, yeah, but it had 2,000. And the 2,000 numbers that were just astronomical, so it was an outlier. And he just looked at me and said, you know what? But it happened. And I've never forgot that, because you have to include these outliers, these tail ends of the curve that could potentially, you know, be a, you know, 1970s type gold rush. You just don't know. But what's really interesting is, let me drag this out for a little while. So check this out. You can see right here, isn't it just interesting how, make sure you're in the strongest asset class. These guys have gone in opposite directions, but, you know, this is breaking out of a bottoming pattern, goes all the way back to mid-2015. That's a 3-year pattern, 3-year first stage consolidation. You can see it clear as day right there. Now it's breaking out. On the other hand, this is looking pretty sloppy. I'm not saying this is going to roll over. I'm just saying this looks prettier than this right now. But if you look at the time periods where all of a sudden, you know, if we go back to the 252 trading days, all of a sudden commodities starts to take leadership, like right here. Okay, it takes leadership. It smokes the S&P 500. You know, from 2000 to 2010 to 2011, so about a 1.5 year period. I mean, it really outperformed the S&P 500 from the looks of it, about 25%. And all you had to do was just own an index fund. I'm not talking about rotating and trying to being smooth about it and day trade them. I'm just talking, you could have just owned an index fund and you would have outperformed. And all you would have had to do is just do what I'm doing right now and just do a look back period. And when you start to see the leadership emerge, go into the stronger one, or at least add it to your portfolio, consider it. But it smoked it, right? And then you had the 2008. 2008, we all remember that. I really cut my teeth in the financial industry as a financial advisor, as an asset manager, but good time to get in. But look at what this did. You had oil and gold, but again, it happened, right? It happened, and you have to understand that these inflationary periods can really, really take off. So it's important when the leadership changes to really pay attention, because if history tells us anything, it can definitely outperform for a good period of time, right? And I'm not saying go buy and hold this forever, but let's just go back to the 252 days. Remember this part right here, where all of a sudden commodities started to come out and take leadership. Now let me go back to 252 days. Look at this. All of a sudden the commodities is starting to emerge out of here as leadership. And if it continues out of here, this might pull back and correct, and if oil pulls back a little bit. But we're going to look at some commodity ETFs here in a minute. So the idea is for you to be aware of the changes that's happening around you and be open to other opportunities. And you always want to have a momentum style of investing, in my opinion. You want to be in the strongest one, right? Because that's where the money is. I always try to be focusing on some of the strongest stocks out there, some of the strongest industries, because the odds are that strength follows strength, weakness follows weakness. I've seen that in value investing and growth investing, right? Something that's going down continues to go down further before it gets better, and something that goes up continues to go up further before it corrects. So here we are right here. Okay, so if we look at, let me drag this over for a minute, and I'm really going to pound the table with this. We're going to come back to that here in a second. But I just had this ETF list, but you know, let's look at some of the, let's just look at wheat, for example. Let me try to drag this. Come on. I want to go to monthly. I don't really care. So look at this. Now I understand that with futures, you know, you have the cost. But for the most part, right, it's a reasonable way to track the commodity without trying to, day trade it or futures trade it. That's not something that I do. But it kind of looks like it's trying to curl around. Now, will it come back and curl around some more? But if this, oops, let me draw this. Corn is probably a little bit better example, but and you could draw it right here, but if you bring it in closer to where it touches, and this is a monthly chart, it's starting to break this steep trend line. Now this is so steep, I don't know how much evidence I would put into it. Then you draw that first stage consolidation. So if we go back to the weekly chart, you see all these times that it rallied above, it rolled back over. So what I'm watching is that 10-day 40-week crossover, the death cross, golden cross rule, because it's just an easy way for a long-term trend. Well, now you have the golden cross, right? And I realized this was a whipsaw. This was a whipsaw. But it's looking like it's trying to consolidate above the golden cross, right? And let's go look at corn for a second. Now, these are agriculture. Corn looks the same. It is spending more time now above the 40-week moving average than any of these moves. This move, this move, this move, this move. Now it's above it longer. And if we look at a monthly chart of this, look, there's accumulation on the monthly chart. So you could be very early if there is a commodities rally in this. But it's just time, I think, to really start to pay attention. Let me be crystal clear. I do not think that these are swing trades. I mean, you can, but I think you're going to get whipsawed and spit out of them. I think that if you have long-term money, like you have, mutual fund money or long-term ETF money, I just think you really need to start paying attention to this. And paying attention to the chart we just looked at, where at least the Rogers Commodity Index is taking leadership over the S&P 500 in the last 252 trading days. So, and these are all futures related. So let's come back here. PowerShares has a good lineup of commodity ETFs. You have, so let's just go back and let's keep it with the 1 year theme. So if you want to kind of dive down deeper, you can always, follow some kind of momentum-based strategy where you're focusing on the strongest commodities. You have the purple right here, which is the energy ETF. Over the last 12 months is up 37%. That makes sense because oil's killing it, and oil's a big weighting. Second, you just have the commodity, the DBC, just a broad-based commodity ETF. So to me, just looking at this, and then you have the base metals, you have the precious metals, and then you have the agriculture down here. So at least in the last 1 year, it's clear to me that if you didn't want to pick and choose, you should just buy the broad base or consider the broad base. I won't tell you to buy it. But, we can look at the last 20 trading days. Energy still continues to be strong. And then you have the broad base, and then agriculture is starting to turn up. So let me go in the last 8 days. So in the last 8 days, it looks like the agriculture is right up there with the rest. So, it's just, you just take a screenshot of these, or you could just go to the PowerShares websites. I'm not recommending these. I'm just saying, if you're trying to break down the sector of commodities and you're trying to find out what's the strongest industry and the strongest sector, this is a good exercise to say, okay, it's clear as day to me that energy right now is the strongest. You might want to overweight that. But if you don't want to focus on that, then just the DBC is fine. So this is just something I do all the time to compare things, and I try to look at, a 1 year chart for a bigger picture. Because a lot of times trends can last for years and years, and then go on. It's showing me that agriculture is really perking up, and all this is really intrigues me as well, that the dollar continues to be strong. So what's going to happen? The difference between the dollar and all these commodities, I don't know. I just focus on the price action, and then if it goes up, it goes up. But this is just really interesting stuff to focus on, I think, and to broaden your horizon. If the commodities continue to show leadership, and also it's also just a great tool if just stocks go out of favor for an extended period of time. You don't want to sit there, watching the screen hoping it goes up. Typically, if stocks aren't going up, you could probably find some commodities that are. So let's go to the sector summary. Okay. Utilities, industrial cycles, it's kind of an odd couple. Utilities is just sometimes all over the place, but let's actually go to the perf chart for a minute. Let's look at what's going on in the last 5 trading days. Energy is pulled back. Makes sense. We can look at that chart here in a minute. Energy is pulled back. Utilities is up. I don't ever really like seeing that. But again, I'm waiting for that flag, that 20 moving average to hold. Utilities and technology, they couldn't be as pure opposite, but technology continues to be strong. So, in the last month, technology continues to show the best strength with energy. So, you kind of got to have some money in some technology stocks of some kind, I think. You always want to focus on the stronger stuff. So let's go look at the oil ETF real quick, and then I want to look at some individual growth stocks. Here we go. So this is the XES, the Spider Oil and Gas ETF. You have West Texas up here. It broke out. It's made a really good move from 42 to 72. Probably deserves a breather. Doesn't mean that it's going to, but it just, if this were a stock and you didn't know this was oil, nice uptrend, consolidation. Nice uptrend, probably a consolidation. This ETF it can really make big moves. So you definitely want to have a profit-taking rule. But you can see right here that this move was up 30%, and then it came back and retraced to about the 61% retracement zone, found support. Chopped higher in a not-so-fun fashion, and then it surged above, so another 25% move, cracked wide open. Now it got all the way back up to close to where it was at and is just gapping down. We took some profits yesterday in our oil stock. We only owned one, just because it was looking a little sloppy up here and looking extended. I would, if it were me, which it is, I'd be looking for another retracement play. I'd be surprised that if it just completely just cracked wide open. It doesn't mean it can't, but just looking at everything and with commodities, it does need a breather, so a pullback, a retracement. You don't want to chase it. You want to retrace it. I'd look for a retracement somewhere in this zone to see if it finds support. But these are big moves. 34%, 20. This is an ETF. This is not an individual stock. So don't take it lightly if it pulls back really hard, because I mean it went up really hard. This is just volatile company. So honestly, to me, it looks like the commodity ETF is a lot smoother ride. You know, for swing trades, I like to find the fast movers, and I like to trade Chinese growth stocks because they can move faster than U.S. growth stocks. And, you know, I've been looking at a lot of marijuana stocks lately. The tough thing about the marijuana stocks is, and I'm not going to get in, I might look at it, we'll just look at a chart here real quick. They're not very profitable at all. And that's the tough thing. So I'm reading more and more, and no, I could care less about these newsletters that promise $1 million. I'm talking about companies that you can hold, even though I'm not saying I'm going to hold them forever. I'm just saying companies that I have conviction with. And a lot of these, what's happening in the industry right now is even the larger marijuana companies, they are expanding, and not organically. They're buying everybody out, which is, and lowering their profits. So I almost look at the marijuana industry as like an Amazon. Amazon, if you think about it, and this is more of just a visual, Amazon, you know, did nothing. Let's look at the monthly chart. Made no money. It was going sideways for a couple of years right here, just plowing back into their infrastructure, not turning a profit. Then all of a sudden it goes up fourfold. That's kind of the way I feel about the marijuana industry right now. They're just plowing everything back because they're trying to build out for capacity. When just it takes over North America, which I believe it will. It's not a matter of if, it's a matter of when. So, you know, I would be cautious if, I mean, this is the marijuana ETF. I don't know how much I would just buy and hold. I'd say if this broke above this and is now holding, but if this breaks this level, I probably wouldn't watch it take another leg down. I would just get out and move on. Because even though I have high expectations for the cannabis industry in North America, I don't want to sit through a 50% move. I have no problem finding bottoms in stocks or ETFs. So why not just wait until it's ready? It might not be ready, but I'm continuing to find opportunities. We're trading some. We're making money with some now. But I think you have to set a reasonable expectation because there's a lot of hype out there. I'm really trying to research companies that are profitable or that I think have a reasonable opportunity to make profits. And right now, just so many of them are just plowing back into buying other smaller companies out and reinvesting. It is just crushing margins and profits. So, you know, I like Chinese stocks. And when I say Chinese stocks, these are Chinese companies listed on the New York Stock Exchange and on the Nasdaq. There's just the growth in China that's going to happen over the next 10 to 20 years is going to far outpace the U.S. There's going to be some pain, yes. There's going to be some major corrections because there's no stair-stepping China's way to heaven. It's not going to be a smooth ride. But there's phenomenal opportunity for growth. So these companies, some of these companies that are being listed have, you know, triple-digit sales, triple-digit earnings. I'm not telling you to go out and buy these companies. Refer to the disclosure at the beginning of the webinar. But what I'm saying is there's opportunity there. I mean, and I'm starting to watch them wake up. The problem I've noticed with some of these positions is they're even more volatile. I haven't played them in a while. I just played one and made a little bit. But they are incredibly volatile. Like it's hard to only, I like to risk 6-7% on the trade max on the downside. You're going to have to risk a little bit more just because of the way they move. This is one stock, I own, and I bought it on this day. I remember I bought it on this day and the market started popping and it was kind of looking like it wanted to roll. So I sold it just because it was lagging. And I didn't want to take another leg down, which it did, so I was right. The problem was it just surged back, broke out, and I mean, at one point in time, it was probably up 20% today. Now it's only up 8%. So, I mean, that's just the kind of, this is an earnings day. Sales double. So look at, and this is just what I'm seeing. Like, look at the volume spikes. Look at the triple-digit sales growth. Like, I'm not just focusing on this company. I'm just focusing on, the internet sector in China. There are so many sectors that are growing. This is another one. Okay. Sorry, that was my alarm. I set an alarm on my phone every day 10 minutes before the market closes. So if I thought about making a trade early in the day and I need to check something real quick and I need to execute it before the market closes, I'll just pull it up on my phone and make that. So 10 minutes before the market closes every day, my alarm's going off to make sure that I don't forget to execute or sell something. So this is another company. Reported earnings. Look at this accumulation stepping in. I mean, this went from $9 to $11.63 in 4 days. Really good return on equity. Sales are starting to accelerate. So, it's just, and again, these are volatile names. iClick. This is something that I wanted to buy earlier, and now it's looking like it's in buy zone right here. It went from 5 to almost 9, a really big move. And then it started to curl around, looked like it was creating a cup with handle, but then forgot, the handle started to drift. But if you look at it, it's still, it's still held the $7 level. So, some of these volatile names, they don't quite hold support like you would want them to. But again, this company reported, and sales are pretty good, and it's looking like it's ready to head higher. So you have, let's just look at some more that I've just noticed that So it's interesting to me, and the reason I'm showing you this because they're starting to wake up. And when you have stocks out of a certain sector all of a sudden wake up, you need to pay attention and figure out if these make sense to your investment strategy. This C Limited, pretty good sales, losses as far as the eyes can see, but it has mutual fund ownership, which is something the other companies don't have. So it trades almost 9 million shares a day, but look at this. Major downtrend, gap up, breakout, all accumulation. I mean, this sucker went from $10 to $15 in 6 trading days. So they can double and triple very, very quickly. I'm not chasing this by any means. I don't chase stocks. But a lot of times these companies, they don't give you a second chance, not even for a minute. So here's something that I almost bought the other day. Almost did it. And I think I would have been frustrated, but it just goes to show you how volatile these names are. So it's kind of interesting. It's accumulation all the way down. It almost looks like the iClick we had just a minute ago. Really good return on equity. No mutual funds on it. Triple digit. So the fundamentals are there. And it's breaking through this level. But it tried to break out yesterday, and then it just completely gapped up in the morning, and then reversed by the end of the day. If I would have bought it, I would have been mad because by the end of the day, I would have been down probably. But it just goes to show you like how. But I've seen this happen with some of these Chinese stocks, and it didn't scare me away from not considering it. This might be a little bit extended, but you want to kind of look at them on the weekly chart, honestly, because I think you'll live longer. But it just goes to show you that a lot of these companies, they gap up out of IPOs, they come down and create a deep IPO base. And when they're ready to take off, you can make a lot of money with them. So I hope this was helpful. I'm not telling you to go out and buy these stocks, but I'm just trying to show you there is a industry, a sector of these Chinese growth stocks in the market where they're starting to wake up, and it's time to pay attention again, although the volatility is just crazy. And some of these Chinese stocks, I don't think they report as good as the U.S. stocks do as far as honesty goes. So there's additional risk there, but there's always risk investing in stocks. So if you have any questions, let me know. If you're not a member of the Traders Plan alert service where we're sending you the picks, we've done incredibly well. I think we've done 12 out of the last 13 closed trades have been successful. So we've been on a really good run, and I think a pretty challenging environment. So check it out, take a trade, email me if you have any questions, and I hope everybody has a great weekend, and we'll see you soon.